Good morning, folks. Happy Friday, and this is your Friday live stream with George Salas here. We are live again in several channels. It's Friday afternoon, feeling good. It's actually Friday morning. We're feeling good today, ready to go on the weekend, but you can't go on the weekend before a 15 to 20 minute short-term rentals and coffee every single Friday now. We've kind of been coming around every 2 Fridays here, but now it's every Friday. So 15 to 20 minutes of some solid advice live here on all our social medias. George Salas, your host today. Last week, we talked about the short-term rental tax loophole. We talked about material participation. We talked about real estate professional status and short-term rental, the actual exceptions, the 100-hour rule. Now, these are all cool things, but now how do I apply that, George? How do I apply that? Now, obviously, just want to give you guys a quick heads up. I'm not an accountant, I'm not an attorney, so this is not financial advice. Make sure you consult with your attorney or your accountant before you actually implement this, because this is for informational purposes only. Okay, so last week we also talked about cost segregation and a couple other things that go right along with our strategy. But this week, we're going to talk about how to implement that. We're going to go for 15 minutes. So take this, write it down, put it on your notes. Make sure you get a piece of paper out, and then just get ready to understand how you're going to implement the strategy. Today's topic is zero taxes with one property. Okay, zero taxes with one property is the annual real estate secret that I've been implementing in our business along with my wife in our portfolio for the last several years to pay zero taxes, right? So listen up, let's go. Again, George Salas, short-term rental expert, fund manager, real estate investor for 7 years already, bringing you here live every single Friday. Now, and this is kind of a practice for our podcast. We're going to be launching our podcast here pretty soon. So this is the practice for me for our podcast. And I feel good about this, fellas, ladies and gents. So we're here live on all social medias, including our group. So let's go ahead and make sure that we are sharing this as we usually do, right? Usually takes me like a second to share, go on my social. Facebook actually went really weird. They removed what it is, the actual, now they removed it. Now you can't share inside groups, which is super weird. So I have to go manually do it right in front of you, but that's okay. That's okay. Not a big deal. So it usually takes me about 2 seconds. So boom, now we're live in our group, Creative Short-Term Rentals. Now this is a very creative strategy. You guys got to hear it out. Okay, today we're going to talk about three different topics. Okay, number one is we're going to understand the concept of what is it really, the tax benefits that real estate does, which is probably, if you're a real estate investor, you're watching this or listening, you probably understand this already, period. Okay, so, but the secret cool strategy that we're going to talk about, that's the second topic for the day. And the third topic is how we implement this strategy. Okay, so let's get started. So, what is tax benefits? Well, truly, tax benefits, right? The common misconception of tax benefits, it's like, okay, well, I gotta buy a bunch of real estate to really benefit from taxes. No, you just gotta buy one property and know what to do with that one property. And then most people think, and I used to think the same thing, that when I bought a property, I would just get a little bit of tax benefits. It's not like that. What you can do is you can actually leverage a tool called cost segregation study done, and you can compress the tax benefits that come with real estate into the first year or 1 year, first, second, or whatever, first year, second year, and then boom, get a big chunk. Okay, so the actual deductions come like this. Okay, so let me make a quick example. So let's say that you're working your job, or you're a real estate professional, you're an agent, a realtor, you're an accountant. You're making 200,000 a year. Okay, or let's call it 150 a year. Right, 150 is good, right? So most people are not going to make 200,000 a year. So let's call it 100 to 150,000. Okay, so you go out there and you hustle, 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 hustle. When you make money, that goes into one of two buckets. It's called active income. right? So you think of income divided as two, right? There's active income, there's passive income. Most of the income is active, right? And only real estate is passive. Okay. Now, when you buy a piece of real estate, you could take, for example, the whole entire purchase price plus the capitalized expenses, which is kind of like all the repairs you've done, and then any staging or design or furniture you've put in there, right? Which we do a lot because we buy short-term rentals, and then you can put it all into the passive bucket, basically, right? You're gonna get passive income. That's what the IRS considers passive income. You get passive income. And then you're also going to be able to do a passive loss, meaning you can take the deduction and do a passive loss for all kinds of real estate except short-term rentals. So what happens is if you do a short-term rental, that actual when it lands into the passive income, it becomes actually active income if you do short-term rentals. So you can deduct your active income side, which you cannot do with all other real estate. Okay, you cannot look it up, ChatGPT, look it up on Google, whatever, right? So for us, we use a strategy called depreciation, and how it works is exactly like I'm mentioning. The depreciation is essentially the I would say it's an actual amount that you deduct, you depreciate from the real estate because real estate gets old. So the IRS allows you to depreciate the real estate year per year. Residential properties is like 27 and a half years, commercial properties 39 years. So you can literally deduct or like sort of deduct one piece at a time, and you can break it down. So if the property is $500,000, you divide that 500,000, aka plus any capex costs, and you throw them into a 27-year, and that's how they do the math. I don't do that math, but the people that do this cost segregation will do it. Your accounts will do it, but it's pretty simple. You divide that by 27 and a half years of residential, and boom, you just get a number, right? So now there's certain different types of depreciations within the property. I'm not going to go into that too much, but you take that and then you apply it to your passive income. Now, if it's short-term rental, you apply it to your active freaking income. And now, if you made $125,000 or $150,000, now if you get a depreciation, negative deduction for like 7, 10K, that reduces your taxable income 7K. Cool, right? What if you actually could make that 7 to 10K become 100 to 150K? Now your taxable income would be what, 125 minus 100,000. Your taxable income would be 25. You're paying taxes on 25K. That's what we've been doing. But how do we apply it to actually, what is this zero tax strategy that I'm talking about right here? Well, all I'm saying is you buy one property per year, right? And then you do this thing called cost segregation every single year by buying one property per year. So I buy a property this year, like we buy a lot of subject to the mortgage properties without even taking the mortgages on. We buy subject to properties. So for me, it's 20, 10, 20, $30,000 per house instead of 20, 30%, right? So it's awesome, by the way. This is not a subject to training, but you guys got to look it up, right? And maybe next week, if you leave a comment here today, I'll drop I'll drop a comment back, and then maybe we'll do a live stream on subject twos that lead into what we're doing here today. Okay. So again, so how do you apply zero taxes? You buy one property per year. Okay. You do this thing called cost segregation. Okay. It's a study called cost segregation, right? And you pay maybe about $1,500 to $2,000 in short-term rentals, and you put that amount of deduction. You convert the amount of deduction through the cost segregation into a larger chunk, and now you apply that to your active income, right? Your 10 properties that you've sold this year as an agent, or your $150,000 as an accountant, right? Or whatever you do, it's probably considered active income. So now you have $150,000 in active income, and you have $125,000 deduction. Now your taxable income is under 25K. Okay. So how do we do this? Well, I kind of already gave it to you. Well, the way we do this is we identify the right property to do this, right? First of all, if you're doing short-term rentals, you can now do this with leasing properties. You have to buy it. Now, if you don't have as much money to put as $100 to $150,000 to get started, you could get started with a lot less money through the subject to strategy. So you identify the right property that, number one, will cash flow as a short-term rental. It'll be suitable for you to be able to deduct, 100 to 125,000. And how you do that? You take it's like a quick math test on that, right? So for the most part, when you're doing these cost segregation studies, what you could think of, like, don't quote me on this, but what you could really do is you could take the purchase price and the capex of the property, the repairs and staging and furniture, put it all together, which is going to go on your balance sheet anyway. Okay. And then you could multiply that by 25%. So that gives you a good idea of around how much you would deduct. So you identify a property that, if you make 100 grand a year, you identify a property that is about 400 to $500,000 in altogether, right? Between the purchase price, the repairs expenses, the furnishings, and your closing costs. So let's just call that 450,000, right? I'm not explaining or mentioning of how we bought that. Let's just say purchase price and all that was 450. Okay, you multiply that by 125,000. That is 112,500. Okay, so then you actually subtract that in your head. You haven't done any math. You haven't talked to an accountant yet. You haven't done anything like this yet. You just, like, as a smart investor and as a strategic real estate investor that you are, you're going to do this math in your head first. Okay. So, okay. Well, that's about 450. It's about 112,500. And I make about 500,000 in taxable income every year. I'm sorry, 100,000 in taxable income every year. So you do the math, that evens out. That's your first step, right? So your property has to be ideal. Now, when I buy properties, they don't just have to be ideal on the taxes, they also have to cash flow. So that's a whole different topic that we can talk. If you drop me a comment and you guys want to understand how I underwrite my properties, you can drop a comment here on the chats, any of the chats that we are live streaming on, and I'll be happy to do or send me a DM. I'll be happy to do another live stream of how I underwrite this property. Okay, so the next step is, we're at step number 3, right, which is implementing the strategy. The next step within is, after finding and identifying the right property, is really executing the plan, right? So you buy the property, right? You close on the property, you stage it, you do the repairs or renovate it, whatever, and then now you're launching as a short-term rental. So once you get the first booking, right, that's when it really becomes deductible. That's when you can really place it in service. It's called place in service. So when you're doing this report, the people that are doing these classification studies, they're gonna ask you, like, hey George, what when was the day you placed in service this property? They're gonna ask you, how much did you purchase it for? How much were your repairs? Or were there any other capitalized expenses, aka capex? And you can add up all the numbers that I just mentioned, and you're gonna send in that information, and then they're gonna be able to send you back in a matter of a few weeks, couple of weeks, a report that your bookkeeper is going to take, and then they're going to implement this and throw it in the actual profit and loss, right? So they're going to add into your profit and loss and into your financials, and then from there, you're going to take that to your accountant, right? Make sure that he also reviews your cost segregation studies. He reviews your financials, and then he's going to make sure that he gets the tax returns. And now you've got zero taxes on those returns. Okay, wasn't that simple, right? So wasn't that much complicated? That really wasn't that complicated, right? If you take the right steps, guys, you can take advantage of paying zero taxes using this short-term vacation rental strategy. And I just told you exactly how. But make sure you consult with your professional, your tax advisor, to give you some strategy within, or your accountant, right? We use a tax advisor, right? Someone that gives me advice and how to strategically position these things so that we don't pay a lot of taxes, right? And we use an accountant, someone that's going to do the actual tax returns, right? So now that could be the same person if they're strategic, right? So anyway. But for more tips, please feel free to drop me more comments. Let me know if you like this, by the way, right? So if you have any questions, um, I'll be happy to answer them. Just drop them here on the chat. We're on YouTube, Facebook, LinkedIn, our groups, personal pages. So I'm happy to bring you here a live stream with some interesting topics, sort of related to taking advantage how to really create wealth and lifestyle freedom through short-term vacation rentals. So, again, George Salas here. Thanks for being here with us. See you every Friday. Bye bye.